what actually is the Super Saver Scheme, who's eligible, how it works step by step, contribution types and the limits, the withdrawal process to take that money out and timing rules when you're ready to buy your first home, and the benefits, trade-offs and common mistakes to avoid. Hello, and welcome to First Home Unlocked, the podcast for unlocking clarity and confidence for first home buyers. I'm Jack Elliott, National First Home Buyer Specialist at Alcove.
And I'm Chris Bates, ex-financial planner and mortgage broker.
Together, we are on a mission to empower you with the keys to unlock your first home. Let's jump in. Hello and welcome back to First Home Unlocked. How have you been, Chris?
Doing well, Jack. It's the middle of winter here. Beautiful sunny day today, but yeah, loving launching this with you. Learning a lot, to be honest. And this is an episode where I think you as a listener and yourself, Jack, even preparing for this probably would have learned a few things as well. You know, it's an exciting episode to do, but it's actually a lot to cover. So yeah, let's get cracking.
Yeah, so as you mentioned, Chris, this episode's going to be all around the First Home Super Saver Scheme. And as you mentioned, there's a lot to cover. We've just finished the buying process from episode 1 to episode 8. So if you're just tuning in now, that's where we've taken you through each step of the process. So that would be a great place to start. And now we're turning our focus to the government support. So we're looking at grants, schemes, and tools that can help you get in sooner and reduce your upfront costs. So as I mentioned, today's going to be around the First Home Super Saver Scheme. And it's a tool that could help you grow your deposit through your super. So what we'll cover today is what actually is the Super Saver Scheme, who's eligible, how it works step by step, contribution types and the limits, the withdrawal process to take that money out and timing rules when you're ready to buy your first home, and the benefits, trade-offs and common mistakes to avoid. So let's start first with the basics. The Super Saver Scheme is a government initiative that allows you to make extra contributions to your super fund. And then you can withdraw them contributions plus the associated earnings to help you buy your first home. Now, it's designed to help first home buyers save more tax effectively because those extra contributions are taxed at just 15% inside of your super, which is often lower than your regular tax income. So saving through super instead of into a normal savings account can give your deposit a tax-based boost. But this only applies to voluntary contributions. Now, the super that your employer pays you doesn't count. And just to be clear, this whole episode is not financial advice. Today, we're just taking you through the factual information only. So if you are considering using this scheme, it's important to do your own research and consider speaking to your accountant or financial planner to confirm if this suits your personal situation. So let's start with what are the benefits of the scheme. So there's 3 key benefits of using this scheme. Now, the first is a lower tax on contribution. So your voluntary concessional contributions are taxed at just 15%, which is often significantly less than your marginal tax rate. This helps boost your deposit faster. The second is the tax offset on withdrawal. So when you withdraw your funds, any assessable portion is taxed at your marginal rate, but with a 30% tax offset. So this reduces the tax that you owe. And the third benefit is that earnings are calculated at a favorable rate. So even though your super fund might go up or down, the ATO applies a notional earnings rate, which is currently at 6.78% when calculating your withdrawal amount. So this is often higher than what you get in a regular savings account. So we've talked the benefits. Now, what are the trade-offs of the scheme? Like any strategy, there's important limitations to understand. So you can only access this scheme once and only for the purpose of buying your first home. So if the circumstances change or you decide not to buy, that money stays locked away until retirement. Timing is critical using this scheme. So there are very specific rules around when you can request a withdrawal, when you can go and sign a contract, and how long it takes for the money to land and be released into your bank account. So we'll cover all that shortly, but it's a common area where things go wrong if you haven't planned carefully. And the last trade-off is there's less flexibility than a regular savings account. So you can't dip into them savings in an emergency or change your mind mid-process. So it's important to have other savings or buffers in place if unexpected costs come up. So let's talk about the eligibility. So who can actually use this scheme? So to be eligible, you must be at least 18 years old, never have owned a property in Australia before. So this includes land or investment properties, have your name included on the property title when you buy that home, and intend to live in the home for at least 6 months within the first year, and never have made a release using the Super Saver scheme before. And if you're buying with a partner, each of you can use this scheme individually if you both meet the eligibility criteria. Chris, a lot of first home buyers have heard of the Super Saver scheme, but aren't really sure if it's worth using. Do you see many of your first home buyer clients using the scheme?
Look, I just had to do a quick search because I was like, when the hell did this come out? And, back in 2017, when I first came out, I had a lot of concerns with it. I thought, how's it all going to work? How does it work on earnings? You're mixing superannuation, which is meant to be for long-term, putting money away for your retirement, with short-term taking money out for property. But there's a lot of the issues have been sort of ironed out. There's still issues years down the line where the scheme hasn't worked for people. But I think ultimately when you look at the way that it works, and particularly when you're a couple, you're saving really hard for a deposit, anything that can boost your deposit is worth considering. And particularly when you're earning more than, say, around $50K a year, if you're on like $20,000, $30,000 a year, you're not paying much marginal rate tax anyway. But as soon as you start going up the tax brackets, there's a real tax benefit. And if you do it for 3 or 4 years, a 15 grand a year, maximum $50,000 that you can do it, as a couple, that could be tens of thousands of dollars of money that could be in your pocket. You don't actually have to save, which could help you with your deposit when you're purchasing. So yeah, Jack, we need to obviously unpack it a lot today, but I do think because it's like down the news feed, 8 years ago, this came out. It's not something that is new and fresh. And so a lot of first home buyers miss this opportunity, and you do have to be careful around the financial years and also how you withdraw it. But I do think it's something that every first home buyer should be aware of and really assess whether it's worth them considering.
And I think, Chris, you're right. I think this is where a big barrier for this scheme is, that it feels complicated for first home buyers, and it's not something people hear about every day. So they're unsure where to start. And this is why we're breaking down this episode, and it gives people that info in plain language so you can go and do your own research. Now, saving for a deposit, as you mentioned, it can be a really challenging part of your journey. So if there's a tool that might help, it's definitely worth exploring. So let's start to unpack it a bit more. So now that we know what the Super Saver scheme is and who it's for, let's walk through how it actually works step by step. So the first step is making the contributions. So there's 2 types of voluntary contributions that count under the Super Saver scheme. The first is concessional contributions. Now, these contributions are made before income tax is applied, and they are taxed at 15% when they enter your super fund rather than at your marginal tax rate. So the eligible concessional contributions include salary sacrifice contributions. So this is where you arrange with your employer to redirect part of your pre-tax salary into your super, lowering your taxable income and take-home pay. The other option is personal contributions claimed as a tax deduction. So this is where you deposit funds into your super from your own bank account as a lump sum and then lodge a notice of intent to claim a deduction. The tax adjustment happens at tax time when you lodge your return. Now, because these contributions are taxed at 15% when they enter the super, only 85% is counted towards your maximum releasable amount under the Super Saver scheme. So, for example, if your salary sacrifice $15,000, only $12,750 is considered when calculating your maximum release amount. So these contributions that your employer makes are still classed as concessional contributions under superannuation law, but they don't count towards your Super Saver scheme contributions. Only the voluntary portion, like the salary sacrifice or deductible personal contributions, can be released later under the scheme. Now, the second way to contribute is non-concessional contributions. So these contributions are made from your after-tax income, meaning you've already paid income tax before putting them into super. Now, this is when you transfer savings from your bank account into your super without claiming a tax deduction. Now, because the tax has already been paid, these contributions aren't taxed again when you put them into the super and aren't taxed when you withdraw them under the scheme. So since they've already been taxed, 100% of the amount counts towards your maximum Super Saver scheme release amount. Now, let's talk about the limits. You mentioned them before, Chris. So you can contribute gradually throughout the year, each pay via regular salary sacrifice, or you can make that lump sum contribution at the end of the financial year. Now, even though general super rules allow for higher contributions, only $15,000 per financial year, can be counted towards the first home super saver scheme, and only 50,000 can be counted across all years. So even if you contribute 50,000 in a single year, only a maximum of 15,000 will be eligible under the super saver scheme. So your maximum releasable amount is calculated as 85% of your concessional contributions you've made, plus 100% of your non-concessional contributions, plus the associated earnings based on the ATO's deemed rate. Now, like I mentioned before, the ATO applies an earnings rate currently at 6.78%, which they review quarterly, to your eligible contributions, regardless of how your super fund actually performs. So this helps simulate investment growth for the purpose of the scheme. So regardless of whether your super fund has a good or bad year, the ATO applies its own rate. Now, this is where it's good to speak to a financial planner or accountant to make sure you're contributing in the most effective way for your situation. So, Chris, for some buyers, saving through the scheme helps with discipline. You can't dip into them savings. But what are your thoughts on the trade-offs, like losing access if circumstances change or if you decide not to buy?
Look, I mean, a lot of good advisors would say, right, absolutely try to have an emergency fund, a little buffer there available. But if you are considering this, let's assume you've got that sorted, and let's assume you've got rid of any sort of personal debt like credit cards and personal loans, etc. I mean, that's sort of your first port of call is get rid of those. Second port of call is get your emergency fund. Third, you're probably past all that because you're thinking about buying your first home and you're starting to build your savings up. So if you're in that position, you're really going to have to think through, well, how long away am I from buying? Am I trying to do it ASAP? Have I got enough cash? And with the other schemes, which we'll talk about on future episodes, with a 5% deposit, maybe a deposit you need isn't as much as you sort of thought. But even if it's 1 or 2 years down the line, maybe you potentially could use this for 1 or 2 financial years. And I do think you've got to be really careful that you are going to use it for a deposit, because it does stay locked up in super, which we'll talk about a bit further down, for years, unless you actually do use it for a property. So you've got to be a bit concerned about that. But there's absolutely tax advantages in doing so. But to get the full advantage, I mean, sounds like it's around 50K, 50,000 is the maximum, but that would take you about 4 years, right? That's a long time to sort of be delaying buying your first home. And so it's going to be hard to use the full benefit, I feel, unless you really started early in your, saving for a deposit. Yeah, that would be my take on it so far, Jack.
And I think, as you said, it's important to get them right buffers and emergency funds in place if you're considering using this strategy, and having them accessible in your savings account for any emergencies that pop up, and even making sure you've got the right personal insurance in place, like income protection might be worthwhile here if you're putting a lot of your money into locking away in super as well. So the second step is then releasing your funds. You've made the contributions, now it's time to release the funds. So when you're ready to use the super saver scheme funds for a home deposit, you'll need to apply to the ATO to release the funds, and this is a 2-step process. So first, you need to request a letter of determination through your MyGov account. The ATO will calculate your eligible contributions and also the associated earnings based on their set rate. So you must request your determination letter before signing any contract of sale, because under the Super Saver Scheme rules, once you've signed a contract, you're considered a property owner, even if settlement hasn't happened yet. So this would make you ineligible to access your funds, and the money would stay locked away until retirement. Now, the second step is, once you've reviewed your letter of determination and confirmed you're ready to move ahead, you can submit your release request through the MyGov. So things to know is you can only request a release once under this scheme. It usually takes 15 to 20 business days for the funds to land into your savings account. And once approved, you have 12 months to buy a home. You can apply for a 12-month extension if needed, but if you don't sign a contract within this period, you must recontribute the released amount less the tax withheld back into your super fund, or face additional tax implications. So other important considerations here is, if you've already signed a contract after getting your letter of determination, but you haven't requested to release the funds yet, you'll need to request the release within 90 days of signing. And also an important one is, if you have an outstanding debt with the ATO, this will be deducted from your release amount. So Chris, have you had clients run into trouble with the Super Saver Scheme because they didn't get their timing right?
Look, I think we have in the past, and I think that was my major concern going back into 2017, is really understand how it's actually going to work and the process. I know you've had these situations in the past as well, Jack, where people have, signed contracts before they've actually requested the release. I mean, what was the situation you can remember there?
Yeah, so back in my early days of broking, another broker faced this and shared it with us, but the client in that situation had put around 20K into their super saver ready to use for their first home, and they signed the contract before requesting the letter of determination. So that's why it's so important to get that letter of determination first. You don't have to release the funds before signing a contract, but actually getting that letter of determination first, because she signed before they requested the letter of determination and she was classed as a first homeowner. So she had to leave them funds. They were able to fix it up with a gift from their parent, but it just shows the timing of everything is really important. So the key thing is getting that letter of determination first before signing any contracts, and then you can release that amount as well. So tax on withdrawal, when you're withdrawing this amount. So when you withdraw from the Super Saver Scheme funds, the amount you receive may include your concessional contributions, for example, the salary sacrifice, and your non-concessional contributions, which is your after-tax contributions, plus the deemed earnings calculated by the ATO at the shortfall interest rate charge. So not based on your actual fund's performance. So here's how each part is taxed at withdrawal. Your concessional contributions and deemed earnings are taxed at your marginal tax rate, but you'll receive that 30% tax offset to reduce what you owe. Now, the non-concessional contributions are not taxed again because you've already paid income tax on them. Now, before using the Super Saver Scheme, just check that your super fund allows withdrawals for the scheme. And if you have a HELP or student debt, just be aware that salary sacrificing into your super can impact your repayment income. So it's worth checking with your employer or your accountant to make sure enough tax is being withheld so you don't get caught out at tax time. So that's it for the First Home Super Saver Scheme. There's been a lot of information and a lot of process that we've gone through there. So we always do recommend doing your own research and speaking to your accountant or financial planner to see if it's the right fit for you in your situation. We've included a Super Saver summary and a link to the official ATO guide in the show notes if you'd like to read more. And we've also linked a calculator that can help you model your own scheme scenarios. Now, this calculator is not affiliated with us, but it's a useful tool to explore how the scheme could support your deposit goals. Chris, have you got any final thoughts or advice for someone considering using the scheme as part of their deposit strategy?
Really just understanding your super is a good idea at any point in your life, and trying to understand, non-concessional contributions, probably not something that a lot of younger people need to even think about. It's often what a lot of planners would use to boost up super balances when people get close to retirement. So it's really understanding concessional contribution limits, and what the opportunity is there and how do you use that, not just for potentially buying your first home, but for your overall preparing for retirement early. And so understanding your super fund, getting it in a fund that, suits you longer term, understanding concessional limits is wise anyway. And then it's understanding, well, do you potentially use that opportunity because you haven't bought a home, a concessional limit, to use this First Home Super Saver Scheme? And so go on a bit of a journey there, particularly when you're getting ready for your first home. All you really can control is saving for your deposit. And it is what it is. So while you're saving, putting all your eggs in, and trying to basically boost your deposit and using potentially this scheme, go on a bit of a journey around improving your sort of knowledge around other parts of finance and understanding your super fund and how this actually works. Really good for your overall financial knowledge. So it's a good episode. It doesn't mean that every sort of first home buyer would use it, particularly if they're coming a little bit late. They're finally switched on and they want to buy a home. And next episode is around 5% deposit home loans, the First Home Guarantee Scheme. You might be wanting to do that next year, and your benefit in this is very limited because of that. But if you're a bit earlier in the journey, definitely understand this because, it definitely can add a few more dollars to your bank account, which can help you with when you purchase.
Yeah, and I think that's the key, Chris. It's all about timing in your situation. And as we said, use the professionals, your accountant, your financial planner, talk to them, get all the information. And that ATO website has all the information you need on this scheme. Give it a read. There's a lot of detail on there. And we've obviously gone into a lot of detail in this episode. As you mentioned, Chris, on next week's episode, we're diving into one of the most popular government schemes, which is the First Home Guarantee Scheme. So if you've heard about buying with just a 5% deposit but aren't sure how it actually works or whether you qualify, that episode's going to be for you. So we'll walk through the criteria, the pros and cons, and how to use it. So look forward to bringing that all to you next week, and I'll talk to you then, Chris.
Look forward to it, Jack.
Thank you so much for listening. We'd really appreciate if you could do us a huge favour. Share this episode with any first home buyers that you know so we can help more people like you feel clear, calm and confident when purchasing their first property. You can join our Facebook group, First Home Unlocked, to continue the conversation with other first home buyers. Or if you're ready to unlock your first home, you can book a get to know you chat by using the link in the show notes or by going to firsthomeunlocked.com.au. Before we go, just a reminder that everything we share on this podcast is general in nature and not tailored to your personal situation. We always recommend seeking advice from a qualified and experienced professional when making financial decisions.